The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Party on, Wayne. Party on, Garth. The post-Fed rally has arrived. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. I love me Wayne's World, so that really worked for me.
All right, we'll prepare for a lot of references to that. And by the way, happy Talk Like a Pirate Day.
Happy did what? Is that a thing?
Yeah, get in character, Alex.
I don't know what to say about that. Okay, let's get in here with the market action. You got the S&P at a record high, up almost a full 2 percentage point, and it is sort of risk on anywhere you look. You take a look at NASDAQ 100 outperforming, up 3%. You got the Russell 2000, not necessarily at a record, but still up 2%. But the S&P and mid caps sitting right now at a record high. And the why behind this, we'll get to that in just a moment. That 210 spread, Romaine, steepening now 13 basis points.
All right, ahoy there, Alex, that post-Fed rally. Well, it really did take a few hours to actually put its pants on, but it is now dressed and ready to party, as that chart just showed. Brian Bilski over at BMO Capital saying that markets are actually going to dance the night away, raising his 2024 year-end forecast for the S&P to 6,100. That's roughly 7% higher than where we stand today. A bullish call anchored to Fed policy easing and the broadening of market participation beyond those big cap tech names. Exhibit A on that point, we'll take a look at the S&P 400 mid caps. While everyone is focused on the fresh record for the S&P 500, it's the mid caps making the more intriguing move, reclaiming all-time highs today with 80% of the index in the green. That includes names like MCOR at a record high, Duolingo at a record high, Toll Brothers record high as well. All told, at least 12% of the index at minimum are at their best in at least the past 52 weeks. Of course, the big test for this rally will unfold over the next 24 hours amid that quarterly dance where index, single stock, and ETF options all expire on the same day. Triple witching that we'll see about $5.1 trillion worth of options fall off the board, Alex, and they will be replaced with, well, that's the big question.
Well, I mean, apparently this is the biggest September triple witching ever on record.
Ooh, shiver me timbers.
It's going to be something, okay? And that maybe that's why you're seeing this rally. You got to kind of change over where your delta is potentially. All right, this is a great chart that really helps encompass everything of what Romaine was just talking about. So the bars here are the small caps versus the S&P. So when it goes into green, you can see the small caps outperforming. Red, the S&P is outperforming, and you can see kind of a steady move of outperformance when it comes to the small caps. Now the question then becomes the why, and that's where this white line comes in. That's the 210 spread. Now, if you take a look back here, when we're in inversion territory, the S&P tends to outperform. Then when you kind of disinvert here, as we started to do, you have small caps beginning to outperform, particularly when it comes to the long end now selling off. That's really leading that curve steeper and disinverting. And the question is this the time for small caps to shine?
We're going to talk about a lot about that here on this Thursday afternoon, the post-Fed day, and a big rally on the back of it, not only in equities, but in other asset classes as well. Michael Pond joining us right now to kick us off to the close. He's head of global inflation market strategy over at Barclays. Great to see you, Michael.
Thanks for having me back.
I don't know if you were looking at that chart that Alex had, but we talk about a 210s curve that we obsessed about for I don't know how many months or years because of its inversion, is now firmly disinverted, at least for now, up around 13. And I am curious as to what that actually means for you. What exactly are traders actually pricing in when it comes to the shape of that curve?
Well, many have been expecting that the inversion of the curve was forecasting a recession, as it sometimes has in the past. But the Fed has been aiming to achieve a soft landing, basically a normalization, which is what forwards have been pricing in all along. Mm-hmm. And so that's what they're achieving. And now with shorter rates moving lower, longer rates are actually moving higher because of less risk of that deflation or recession that the market had been pricing in just a couple of weeks ago.
How, if at all, do you reposition a fixed income portfolio around that scenario? Is it necessary?
Well, it's largely as expected. Mm-hmm. So we've been positioning for a while for a steeper curve, mm-hmm. Shorter short end rates. Or lower short end rates, higher long end rates. We think that can continue. We expect the Fed to continue to cut rates 5 or maybe even 6 times by the end of next year. What we find odd, though, is the market is pricing in much more cuts than that, mm-hmm. and yet the inflation market, which is where I focus, is actually pricing in core inflation, as our math shows, above the Fed's target. So you have that combination where you have a very aggressive Fed, at least relative to what the Fed is forecasting, what we're forecasting, but baseline inflation expectations. So we think there's a little bit of a disconnect there. We think either the market needs to price in less Fed cuts or the inflation market needs to price in lower inflation.
So you guys were looking at about 5 cuts for the rest of this year and for 2025.
The combination.
Yeah, the combination. So does that imply which one of those theses? Does that imply that inflation actually moves a little bit higher or stays a little bit sticky? Like, why don't you have 8 or 9 pencils?
It's a fairly Goldilocks scenario where the unemployment rate goes up a bit from here, but not much. And then comes down by the end of next year to about where it is now, about 4.2%. So that's a fairly benign scenario, very consistent with that soft landing that the Fed has been able to achieve. And that is combined with the inflation the inflation rate continuing to move down towards about 2%.
So let's just game that out and say we do go to 5 and not more as the market's really pricing in, right? What happens to the market in that scenario?
Well, first, I think that the Fed funds market is already pricing in for a decent risk of that. As I point out, I don't think the inflation market is pricing in for that downside risk. So in our view, Fed funds may go down further, but it's the inflation market that needs to adjust much lower in that deflation or recession type scenario.
This may be a dumb question, but does it matter that with the Fed easing, does that sort of disrupt, though, the inflation outcomes, if you will? There's been a lot of talk that as they start cutting, maybe this then restokes inflation, or at least restokes consumer spending in a way that actually stokes inflation. Have you sort of modeled that out at all?
We have, and inflation is relatively low price by the markets across the entire curve. So whether we look at the 1 year, 2 year, 3 year, once we strip out the first 6 months, which is mostly about oil, the market's priced for a little bit above 2% inflation, which might be fine for the 1 year or 2 year, but that's also true for the 10 year and 30 year. So we think that there should be a much higher inflation risk premium in the curve. In other words, the market is pricing in free inflation insurance. You should buy some when it's free. So we think that longer inflation expectations or longer break-evens offer good value here.
Yeah.
And that's why we saw good demand at today's 10-year tips auction.
Yeah.
The $17 billion was taken down quite easily.
So when you saw, first of all, I love inflation. I love insurance.
You love inflation.
No, I'm a huge insurance person. I'm like, let me just sit and put stuff in a safe place and not look at it. So, but to that point, if inflation stays a little bit sticky and we saw the Fed revise their neutral rate up a bit, do we think the neutral rate has to be a little bit higher? And then what does that look like?
Well, what the Fed revised to higher, which the market sort of already has, is the neutral real rate. So in other words, their inflation expectation in the S&P didn't go up at all. 2%, 2%, 2%. That's their mantra, and we don't expect that to change. But what has been creeping up is the neutral nominal rate. But if the inflation rate's not going up, that means it's the neutral real rate that is going up. That's about productivity, about labor force growth. So those things have been stronger. We've been getting stronger labor force growth in part because of immigration. And we've been getting potentially stronger productivity growth, expectations of productivity, in part because of AI and technology that may be boosting productivity longer term.
All right, great stuff, Michael. And actually, just before I let you go, you guys, your house call was for 25 basis points at this most recent meeting. We got 50. With your rate cut expectations going forward, you expect them to stay at a 25 basis point pace?
That's right. We essentially think they pulled forward some cuts that would have happened next year.
Yeah.
So we expect 2 more 25s this year.
Yeah.
We think they could go 50, but the data really has to weaken much more than they expect for them to do that.
All right, great stuff. Michael Pond, head of global inflation market strategy at Barclays, kicking us off to the close on this Thursday afternoon. When we come back, a trip out to San Francisco and a conversation with the CEO of Salesforce, Marc Benioff, sitting down for us live from his Dreamforce conference.
All right, plus the market eating up shares of Darden and asking for seconds. The Olive Garden owner announcing better sales and a new Uber. Cool partnership. We're going to have more on that in Top Calls.
Have you been to an Olive Garden before? Because yesterday we learned you've never been to a Cracker Barrel.
No, I've been to an Olive Garden probably in 2002.
All right. Well, I know you've used FedEx, and as everyone has, and we're going to get results out of that big company after the bell tonight. A lot of people looking at some of their idiosyncratic issues. Others really want to peek into the holiday shopping and shipping season. Stick with us. This is The Close on Bloomberg.
I'm David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week.
More than what you need to know, it's what you need to think about.
Global stocks rallying, S&P looking at its 39th record close for 2024 alone. So what do you do in this kind of environment? We're going to ask Callie Cox, Chief Market Strategist over Ritholtz Wealth Management. Callie, do you buy this record rally right now?
To buy as long as the economy stays okay. And notice I didn't say solid, I said okay at the moment. Unemployment, of course, is climbing higher, but we're seeing a lot of that as a result of the labor force expanding. And look, I think that there are risks on both sides right now, but the risk of sitting this out seems to be higher than the risk of potentially buying at the top.
So it's not just the S&P that it's at a record. It's really mid caps that are at a record as well. The Russell's also having a nice run, but not at a record high. Where do you have to be within this record rally?
Well, I actually think the fact that the Russell 2000 hasn't seen a record since 2021 is a positive thing. I think that there's room to run here, Alex. And you're right, mid caps and small caps are catching up because markets have anticipated rate cuts, not just that 50 basis point rate cut, but more rate cuts after this for a while now. Look, higher rates have been holding back small and mid cap stocks. So small caps are actually one of the areas of the market that we see the most value in. And we think if the economy stays okay and rate cuts can, reinvigorate growth a little bit more, then small caps could be the area to watch.
Well, but sort of underpinning that idea, though, Callie, is the idea that we're actually going to see some better earnings out of these companies. This really wasn't a revenue story. This was about balance sheet issues. And of course, I think what a lot of people saw is that bottom line not keeping up with the big cap stocks here. In order for that thesis to come true, you also have to believe that the economy is holding up, right?
Yeah, you absolutely do. And the reason why small caps are more, I'd say attractive in this environment, but also more sensitive to rates coming down and the economy staying solid is because a lot of small companies are more domestic focused. They don't have that international revenue source like some of the bigger, let's say big tech stocks, for example, have. So, these small companies have been crushed. There have been recession worries. They're more reliant on debt, but revenue expectations have been coming up. And, these companies have learned to manage costs. And now that they're getting some relief from rates, we could see them, potentially stretch out and, look into new expansions and potentially generate more business on their side of the equation.
Are there certain sectors, Callie, that you're looking at that maybe could provide potentially better relative returns than the others?
Well, we like the unlovable areas of the market, or the unloved areas of the market. So I already talked about small caps. That's an area of the market that we're watching closely. We also think it's worth taking a look at rate-sensitive sectors, value stocks, or stocks that are trading close to the earnings they're generating. More of this rotation that we've seen since the middle of July, now that inflation has come under the control and now that we have the first rate cut under our belts.
What do you then do with financials? They're getting a boost today as well. How does that play into an economy, like you said, that's okay and rates coming down?
Well, financials are interesting, right? They benefit from a bit of an uninversion of the yield curve, of course, because their net interest income comes from, making those loans, but also being able to manage the costs on the deposit side. I think if the economy stays okay and if rates keep coming down in the best kind of way, in a celebratory way, then I think financials could stay attractive here. But you have to watch them. They are obviously economically sensitive. They're one of the more economically sensitive sectors out there. So if we see some trouble in the job market, you could see that manifest itself in banks first.
All right, Callie Cox, Chief Market Strategist over at Ritholtz Wealth Management. A closer look here at the big moves that we're seeing in the small and mid-cap space here. Interesting, though, if this is tied to economic conditions, we're getting another maybe potential read into the global economy. This out of Mercedes-Benz, which is actually cutting its full-year forecast for cars. It's basically seeing about 7.5 to 8.5% growth. Its previous forecast was 10 to 11%. It's blaming a deterioration of the macroeconomic environment. and of course also cites China as being a big culprit of that. And obviously, Alex, this is more of a global story of what we're hearing out of Mercedes, obviously based in Europe and obviously does a lot of business in Asia. Whether that has reverberations here in the U.S., we'll have to see.
Well, and it's interesting, too, because their sales mix is expected to remain unchanged. So this isn't like an electrification thing.
Yeah.
This seems to very much be a specific China macro environment thing. And that's the problem when you're looking, say, for value in Europe, right? So many of those sectors and so many of those companies have big exposure to China in a way that companies here don't. How do you deal with that as an investor?
Yeah, absolutely. Interesting. That return on sales, 7.5% to 8.5% out of Mercedes-Benz, a cut from their previous forecast of 10 to 11%. When we come back after the break, we're going to take a closer look at the health of the restaurant industry. Darden Restaurants delivering a better than expected quarterly report and a clutch partnership with Uber. We're going to digest those results next in Top Calls. This is The Close on Bloomberg. All right, let's get a view from the sell side with our top calls. The big movers on the back of analyst recommendations, and we start off today with Elanco, the maker of pharmaceuticals for pets and livestock, a downgrade today to equal weight at Morgan Stanley. The analyst there saying the animal healthcare company lacks conviction in its near to medium term strategy, and she says that the pet care landscape is growing a lot more competitive, making it difficult for it to differentiate its key products. Shares, though, getting the bid on the day up 2%. Moving the other direction is Casey's General Stores. JP Morgan cutting the convenience store chain to underweight under the guise that its valuation is stretched due to recent outperformance. He also expects convenience stores overall to face challenges from potential weakness in discretionary purchases. Casey shares down 2%, down for a fifth straight day. And finally, let's take a look at DoorDash, an upgrade to buy from neutral at BTIG. The analyst says the food delivery service is hitting important milestones with positive earnings and net income expected in the second half of this year. He also says investors are underappreciating DoorDash's long-term growth drivers. So shares up about 3.5%, and those are some of our top calls. We do want to stay in the food space, and specifically the food delivery space, because Darden having its best day going back, well, to at least the last few years. The restaurant owner of dining brands like Olive Garden, Yard House, Cheddar Scratch Kitchen, none of which Alex has ever been to. But now, get this, Alex can just order it from Uber. Darden out with his first quarter results this morning to show a promising recovery, and Darden also teaming up with Uber to deliver food from Olive Garden starting this year. Nick Setyan joining us right now, Managing Director and Equity Research Analyst covering restaurants over at Wedbush. He currently has an outperform rating on Darden shares. Darden having a really good day here. I was just looking at the superlative here. Best day going back to 2021. Nick, let's start with this Uber partnership because this is a big deal. Darden had really resisted. We've spoken with the CEO before. They had really resisted going the third-party delivery route. What pushed them into the arms of Uber?
I think it's market share shifts, and I think they realize that, look, some of these other competitors, peers like a Brinker, with Chili's is doing, better, and a part of the reason is, it's being helped by names like Uber and DoorDash, and so I think that's where the consumer's going. I think that's where the peers have been in a while. I think they realize that in order to maintain their share, they need to be there too.
What's the economics of that look like? I mean, when we talk about these partnerships with Uber and some of the other delivery companies, it always seems that those delivery companies take a big chunk, a significant chunk, I should say, of that revenue. How is this structured in a way where it's profitable to Olive Garden?
Well, it certainly impacts margins. I mean, there's no question about it. That's why they've actually tried to resist going in that direction. But, you tend to price a little bit higher on the third-party delivery channels. In such a way where, the dollars stay relatively the same, but the margins are slightly lower. So clearly the middleman takes some of that chunk.
Mm-hmm. But does this mean that, Nick, that maybe they will avoid any sort of deep discounting price war here?
It's going to be difficult to avoid a deep discounting price war. They've tried very hard. I mean, pre-COVID, their, marketing spend as a percentage of sales was 4%. They went all the way down to 1%. It's now back up to the mid ones. It's probably going to continue to tick up. And one of the reasons why, the stock is up, in fact, the main reason why the stock is up is because they went from negative comps in July to flat comps in August and positive comps in September. And those positive comps are being driven by very specific price point promotions, bringing in the all-you-can-eat pasta, a week earlier. And going forward, they're going to have to focus on more price point promotions because that's what Brinker's doing. That's what Applebee's is doing. And they don't really have a choice if they want to maintain their market share.
That's what I don't get. So it's the all-you-can-eat pasta. So you have all those kind of gimmicks that bring people in the door, but you can't get that if you order through Uber. So why wouldn't someone just order a regular pasta joint? How does that actually help them?
I think they're focused more on the new customer and some segments that they don't reach, right? I mean, so there actually has been a lot of data on the fact that these third-party delivery, apps, they actually do reach a segment of the customer that doesn't necessarily overlap with, any given restaurant's regular customers. I think one of the reasons why they are going this direction is to try to reach a newer customer segment.
Well, I want to talk a little bit more about the actual in-store diners and the traditional business, because we know that had been hurting. We saw a little bit of a rebound, kind of a return, if you will, back to growth rates, at least for right now, that I think the market can get comfortable with. How much does that continue, independent of whatever this deal is with Uber? How do they get there beyond just offering promotions?
Well, I mean, I think we have to put it in context, right? I mean, again, like I said, they were very promotional pre-COVID. Everybody was during COVID. I think that, the customers just felt better, so they weren't looking for promotions as much. But we were now in an environment where, customers are normalizing. Their habits are normalizing back to what we were used to, for decades pre-COVID. And so I do think they're going to have to, increase that marketing spend a little bit more. And so go back to, some of the things that they used to do in a more normal environment. And that's being driven by the competition, right? I mean, ultimately that's what Chili's is doing. That's why Chili's comps are, double digits right now. That's what Buffalo Wild Wings is doing in response. That's what Applebee's is doing in response. They're going to have to spend more on marketing and promotions, period.
All right, Nick, we appreciate it. Thank you so much, Nick Setyan, over at Wedbush. We appreciate that, which brings me to a 50 basis point cut from the Fed. Is there but that's my point. Is there a direct translation? Oh, good, the Fed cut, I can go eat more. Like that's where the real economy is, right? These kind of companies.
Yeah, I mean, that's the kind of the holy grail. Ideally, that would be the case, but how long does that sort of trickle in?
Exactly.
How much are people even aware of it? And is that even going to really show up? And where does that show up? It shows up on your credit card statement, but you still got to spend the money first, right?
Exactly. So is it really going to move the needle for some of the consumer discretionary places?
The more important thing here is we have to get you to an Olive Garden. Have you been to any of the other properties, Longhorn?
I have not. I'll go to Longhorn.
Capital Grill.
Totally go to Longhorn. I've done Capital Grill.
Bahama Breeze.
No.
Eddie V's.
You're just reading it off the press
Seasons
release.
52.
Have you?
Cheddar Scratch Kitchen.
He has not.
Never even heard of it.
I'm saying no. I mean, Capital Grill's down by Wall Street, so if you're by the exchange. Anyway, all right, coming up, the man who got the call right from the Fed, Mike Feroli over at JP Morgan. This is Bloomberg.
Here's the headline. Fed cuts interest rates by 50 basis points and the bond market returns are going to be negative today.
This was a huge victory for Jay Powell, who really laid out at his Jackson Hole speech that he was worried about employment. And that is what this is about.
The market's going to look at the median dot and will interpret this as a dovish 50 basis points cut. And the first reaction was actually steepening of both 2s10s and 2s30s, which tells you something about what people are worried about.
All right, those are some of the guests that we had on Bloomberg Television reacting to the Federal Reserve's half percentage point cut yesterday. Romaine Bostick here alongside Alex Steele, still parsing the market moves on the back of that.
Yep, now it's a different story. My question, though, for the market, is it really about the Fed cut yesterday, or is it really about options expiration tomorrow and now needing to kind of rejigger what your delta is going into that?
Yeah, and it's also about economic conditions. And I think that a lot of people were so focused on the actual cut yesterday, but they also seem to kind of look ahead to next year and to look what was in the SEP, looked at what was on that dot plot. And I think that emboldened a lot of people. Scared, I think, some people at first yesterday, but I think you saw the bids come in today into those small cap, cyclical names, economically sensitive names. At least for today, that seems to be the trade.
Yep, and you can see by the back end, too, selling off. So one of the two banks that got the Fed call right yesterday, sticking to their 50 basis point cut call after the August jobs report. And the man behind one of those calls is here in studio with us, Michael Feroli, JP Morgan chief U.S. economist. August report comes out. You're the first to say, OK, they're going 50 in September. All the other banks were like, nah, 25, 25, 25. Citi was the exception. You stuck to your 50 and you were right. What do you think they're going to do next month?
So that was a July report that we changed on the July report.
In early August of July. Yes.
Yeah. So right now we're looking for another 50 in the early November meeting, but that's very contingent on what we get in the next two jobs reports for both September and October. Given the deterioration we've been seeing in overall labor market conditions, if that trend continues, I think they would be compelled to get closer to neutral yet again in a speedy fashion. However, if we stabilize here, I think without a deterioration, I think it would be tough for Powell to pull the committee into another larger cut like he did.
What would deterioration look like? Like what it feels like they have zero tolerance for any rise in the unemployment rate. So what does deterioration look like for that 50 basis point?
So I do think a rise in the unemployment rate would be something that I think if we were to see another 0.2 move up over those next two reports, I think then it becomes an interesting meeting. I think if we start to see private payrolls break below 100K like they or further below 100K like they have been doing, I think that would also be something that the committee would have to reassess their plans that were in yesterday's SEP.
How much do you trust in that data? There's been a lot of talk about how, particularly on the unemployment rate, there's some distortions there because of immigration and a few other things with people coming into the labor force. Kind of give us your general sense here of how you read that.
So there are always distortions. They're probably larger than normal now in part because of the large immigration numbers that we're seeing. I think that probably is less of a problem for the ratios in the household survey, like the unemployment rate, like participation rate. I do think there are some broader concerns, which Chair Powell mentioned yesterday, about the non-farm payroll number, which not only has been getting revised down on a monthly basis, but we had that big annual downward revision a few weeks ago. So that does raise a question. We're always kind of looking in the rear, in a foggy rearview mirror at the economy, and it's a little foggier than normal now.
But that gets to the issue too, is like even if we do see a material slowdown in hiring, does that mean we're also going to see an increase in firings and layoffs? Because so far that hasn't really materialized.
So far that hasn't materialized. You're exactly right. The increase in unemployment has been just due to softer hiring. However, usually when you see that rise in firing, you're pretty well into a slowdown, or at least a material rise in unemployment rate. So if you wait till then, you're already probably obviously in a recession. So we haven't seen that yet. We're hoping to stay out of it.
Which is exactly probably why they cut 50 yesterday, which is what Jay Powell made clear. Do you feel, though, that were rate cuts pulled forward from 2025, or accumulatively there's just more than maybe we would have thought 8 months ago?
Yeah, well, I think some of it may be rate cuts that were a rate cut that should have happened in July, which Chair Powell even was pretty frank about conceding that, which usually central bankers never admit to making mistakes. But I think he owned up to that, and that may be why we saw that 50 yesterday. I'm not sure we're pulling forward. Well, I suppose we are pulling forward not only from 25 but from 26, because the end state here has always been to get back to neutral. They haven't signaled yet that they anticipate going into accommodative territory. That neutral is a little higher than it was, but ultimately they're still getting to the end state, but just a little faster.
And that's what I'm confused, because it feels like the disparity between those that think that neutral is like has a 4 handle, or like a 3, or like maybe a 2 is quite large, depending on who you're talking to. And that's a very different economic cycle, depending on whether it has a 4, a 2, or a 3 in front of that.
Right. So at least on the FOMC, that's a 2 or 3 handle, right? The top is still 375. As you get out to the broader private sector, you're going to get, of course, wider dispersion. So you're right. There's a lot of uncertainty there. I think, as Chair Powell has made clear, that's not going to be guiding the decision every 6 weeks, and that's I think that's appropriate.
With regards to just broader health, I mean, beyond just the labor market, there's been a lot of issues, or concerns, I should say, with regards to consumer spending. It hasn't quite shown up in the data, but we certainly heard from a lot of corporations that have made it clear that people aren't spending the way they used to spend, at least not on discretionary items. How are you viewing that sector of the economy right now, and is it going to be more of a concern for the Fed over the next few months?
So I really can't divorce concerns from the consumer around concerns about the labor market. I think the consumer balance sheet still looks fine. It doesn't look quite as healthy as it did a year or two ago. But overall, most of the metrics we see look pretty decent. As you mentioned, the actual spending numbers are still solid. However, that's really being driven now by labor income growth, right? With the saving rate down to 2.9%, it's unlikely that consumer spending is going to be driven by further declines in savings. So we really need to see nominal labor income continue growing, and that's why any falter in the labor market would then ricochet through to weaker consumer spending.
What about the sentiment side of this, right? Because at the end of the day, you have a lot of regular Joes watching everything that's going on, and it can be a little scary.
Yeah. So, this kind of circles back to the issue of, I think, some of the distorted indicators we're seeing. Maybe this isn't a measurement distortion, but the link between economic sentiment measures and the actual economic performance seems to have a lot more slippage than it did in the past. And there is some concern that this may be, a residual of the polarization that we're seeing in our society, and that affecting even simple things like how people see the economy.
Yeah.
So a risk that we could see a reheating of inflation and a reheating of growth and demand on a jumbo cut in the cycle. True, false? What's your probability of that?
I don't see that right now as a huge risk. I mean, we didn't have that big we don't anticipate that big a move in things like mortgage rates that would cause, the housing market to suddenly, pick up steam. Now, if we go into a more aggressive easing cycle rather than just one aggressive ease, that is a risk. But, if you don't like uncertainty, you shouldn't go into central banking. There's going to be risks to both sides, and certainly that's the one. That's one they're trying to balance here.
Well, there's a couple of members of the Fed that I don't think quite understood that, but I guess we're going to start to hear from all those people. Fed speak, Alex. I know you love it.
Love it.
So does Michael. Michael Feroli, one of the best in the business, chief economist over at J.P. Morgan. We just got about 20 so minutes until we get to the closing bells here on the day, a day where we're seeing meaningful outperformance in mid-cap stocks. The S&P 400 mid-cap reclaiming its record high today. We're going to highlight some of the big movers in that index as part of our Stock of the Hour. It's up next. This is The Close on Bloomberg. Just about 18 minutes until the closing bell. Green across the screen with the S&P 500 at a record high, up 2% on the day. But get this, so too are S&P 400 mid-caps, a 1.7% here gain on the day, giving it its first record high for mid-caps since July. Low valuation, solid economic growth. Some folks saying that implies more upside ahead. Abigail Doolittle joining us right now to talk a little bit more about this. We're looking at the Russell. They are small caps, but let's start with the mid-caps here because obviously, in theory, those names probably are in a little bit better of a financial position than some of those small cap names. And that seems to be where some people are gravitating to today.
Yeah, I mean, those companies, the mid-cap companies, are going to be a little bit safer in terms of their balance sheets, their financials, the businesses that they have than the small caps. So, yes, we're seeing this record high. And it's not just today. We've had this rotation into the small caps and the mid-caps over the last few weeks into this Fed meeting, which is really interesting because while we had that, the NASDAQ 100, its last record high is back in July. So the S&P 500 ahead of the Fed yesterday flirted with a record high, then has put one in, whereas the NASDAQ is still trailing. So the big tech companies that have done so well all year, we've seen this catch-up trade for these smaller companies, people really expecting that Fed rate cut to help. And the fact that it came in 50 basis points certainly juicing it.
And go ahead.
No, I was going to say that's a good point about the NASDAQ and it's trailing. I mean, the S&P is hitting that record high, the mid-caps, but then you see big tech still kind of lagging behind.
Yeah, like outperforming on like a percentage basis today, but like on a relative basis from that? No. What's interesting is Bank of America sort of heightened my awareness of the mid-cap, saying that that's a sweet spot, right? You don't have the same kind of risk of debt as related to the small caps, but you don't have the valuation issue that you do with the large caps. And everyone I've talked to since then is like, yep, mid-caps is my jam.
It's so interesting. I love the fact that we are talking about mid-caps because in a former life, when I worked for an asset manager, you know, like one of the style and the size, mid-cap, that was a big piece of the portfolio, you know, between the large, the mid, and the small. But typically here, we're not talking about mid-caps, but now because of the love that this, you know, sector, this size is getting, capital size is getting, for those very reasons. You just don't have the risk that you have with the small caps. I mean, think about it this way. In the Russell 2000, there's 2,000 stocks. You know, the mid-cap 400, there's 400 stocks. What's interesting is the divergence between the SML index, that's the S&P 600 small cap. Now, today up just slightly. Now, on the year, also up less than the Russell 2000. So the gaming money, it's considered to be the higher quality small cap index. So the gamier money going into the Russell 2000 more so than that S&P 600. It tells you that there's risk on animal spirits stirring today.
Well, we should point out the SML did gain some traction here on the day, now up about 1.9% on the day. But it gets to the broader question, too. There was a great note out maybe it was a week or two ago, from Goldman saying that this could be kind of a Goldilocks situation for mid-cap stocks. They were actually projecting 13% upside just through the end of the year for mid-caps alone. And again, this all ties back into the idea that what led to the big sell-off in those names, at least for now, that appears to be they're out of the woods.
I'm so puzzled by my Bloomberg terminal right here because I'm seeing 0.09%, but it also looks like it was a little bit frozen. I'm not quite.
Okay, yeah, we can get to that later.
Quite sure why, but I'm glad that you're correcting me on that. So
I like to correct people. Don't worry.
The year-to-date figures as well. In terms of stocks being out of the woods, I think that it's too early to say that. Just from you guys know I love a good chart. We still are range bound, and the most important stock in the index, it's not small cap, and I think you can probably guess what I'm going to say. Nvidia here, it is as good of a day as it's having. It's still bound by resistance. It tells you that nobody's convinced that this liquidity stream is going to be strong and far enough. Yeah.
All right, Abigail, thanks a lot. We appreciate it. Bloomberg's Abigail Doolittle joining us there. Sectors of the hour, sort of size of the hour instead of stock. All right, we're about 15 minutes away from the closing bell here. You're looking at the Nasdaq up by 2.6%, the S&P up almost a full 2 percentage point. Coming up next, we're going to take you to San Francisco for Salesforce annual Dreamforce conference. Emily Chang standing by with Salesforce CEO Marc Benioff.
This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. You're still taking a look at a market right around a record high.
Kind of interesting to see this delayed reaction to that Fed report. I know we've seen this in the past, but kind of interesting. We saw a bit of a sell-off yesterday, but today, one of the best rallies we've seen in quite some time. Okay, so keeping an eye here on the markets as we move closer to those closing bells with just about 10 minutes to go. We do now want to welcome our Bloomberg Television, radio, and YouTube audiences worldwide. We want to go out to San Francisco, where Salesforce is holding its annual Dreamforce conference. The software company unveiling its AI strategy. Pleased to say that Bloomberg Originals host Emily Chang sitting down right now with CEO Marc Benioff at her side. Emily, take it away.
Romaine, thank you so much. Marc, it's always great to be here with you at Dreamforce.
Welcome
You're the star
back to
of the
Dreamforce.
show, the rock star of the show.
Thank you.
Agentforce, of course, and you rolling that out is the big thing. I've been talking to some of your customers. They're very excited. Tell us about what LLMs you built this on. Is it OpenAI? Is it Anthropic?
I've never seen the customers more excited. And the reason why is these customers have been convinced something that's not true, that they have to buy an LLM, they have to go to a hyperscaler, they have to get a database, they have to buy a security technology, they have to choose a chip. They have to hook it all together themselves. They have to DIY their AI. It's not true. You do not have to DIY your AI. And when we started the show, they didn't really believe it. So that's why we created a whole factory across the street, as you saw in Moscone West, where we have put more than 10,000 customers through already to show them that on the Salesforce platform, which they've already been committed to for more than 20 years, had great success in sales and service and marketing and communications and commerce and analytics and Slack and in all of these technologies, that now they're also building AI. And this is a shock to them, and it's exciting for us because we're showing them how, once again, we're future-proofing their company with the Salesforce platform.
So you've basically DIY'd it for them. And
well, that's our job. We're a software company.
What models you've built it on? Is it
we have our own, we have
Anthropic?
many, and they don't need to know.
Okay.
And they don't, why, what chip am I using? You know, what hyperscaler? They don't care. They don't care what I'm using. You know, it's like, what type of flour is in the cake? What kind of sugar did I buy at the store? Why does it matter? Do you like the cake? Is this the final product that you like?
All right.
And I think that for our customers, they don't want to know all the pieces. They want to know, does this work? And can they make a greater success for their own companies? And so when you see like a company like, you know, Wiley, who's here, and they're like, lower their cost by 50% day one.
Right.
And that is the power of technology, that we're going to help to make it easier for them, lower their cost, deliver a high ROI. And the Salesforce platform just delivered that for them.
So let's talk about how it works. You know, a lot of companies are rolling out agents now, ServiceNow, Microsoft. How do we know this isn't just another buzzword like Copilot?
Well, I think you know that and we all know now that Microsoft Copilot is basically the new Microsoft Clippy, that customers have not gotten value from it. You know, these LLMs, this is like, we're selling science projects to companies, and they're tired of it. They have not gotten the value, which is why you see these customers so excited. They're coming here and they're getting immediate value, and they're able to use this next generation platform to do everything that they've heard that's possible. Create an agent is a great example. How do I fine tune an agent? How do I create guardrails for an agent? How do I ground an agent in data? Well, all the data is in the Salesforce platform. All of the metadata is there. The logic is there. The workflow is there. They're just adding agents into their existing workflow. And no one knew it was possible before the show, so we knew that because we hadn't created the product, and now it's so exciting because we've onboarded tens of thousands of customers, and we've convinced them you don't need to DIY your AI. You can just use, and you're going to get the best AI, the highest accuracy, the lowest hallucination rate. Our customers are saying in many cases it's 2x the accuracy of the best models.
So look, it's not always going to be smooth sailing. Disney actually just announced they've dropped Slack because they got hacked, and said they're switching to an enterprise-wide collaboration tool, which sounds maybe like Microsoft. What are you doing to improve Slack security, and what's your, response to that?
Well, listen, I think our security is rock solid. This is really important. And also there's no finish line when it comes to security, but companies have to also take the right measures to prevent phishing attacks and to lock down their employees from social engineering. So we can do our part, but our customers also have to do their part. That's extremely important. But the second thing that's important is, over 25 years, we've shown that this model is the most trusted, most secure, most capable model. Disney's a great example. They run the Disney Store on Salesforce. The Disney Guides are on Salesforce. All of the sales and service operations, Disney Plus call center and contact centers on Salesforce. We are the customer service capability, and they're the proving ground actually for our new AI system. So our next generation AI was actually proven at Disney. It's amazing. They've shown us incredible metrics, and I'm really looking forward to, future success with Disney. But it's incredible that customers are able to see this value from these platforms. That's what's really exciting.
And let's talk about the money, because I'm curious about how you got to this $2 per conversation and just how much additional revenue you think Agentforce is going to drive.
Well, look, our goal is very simple. We want to get what we call 1 billion agents, in place for our customers within the next 12 months. And that means we're going to have to deploy it in hundreds of thousands of customers, and get them all to roll this out to build this huge blanket with all of their consumers. And of course, the funny thing is we say 1 billion agents, but it's only one piece of code. The Salesforce platform is automating all your customer touch points, building a huge data cloud and all your agents, but it's all one piece of code that you're just connected to. And that idea that it's one piece of code, well then we've always charged, per email or per commerce transaction, and now per conversation, and it's consumption pricing. In some cases, it's per user pricing, like in our Sales Cloud or our Service Cloud. So it's a mix of two different pricing models. But we're, of course, work with our customers, and we have tens of thousands of customer-facing professionals who work with them to make the right agreement with our customers every single time.
All right, well, it's great to be with you here in person and to see
always fun to be with
Agentforce in
I'm so
action.
Thrilled you could come back.
Salesforce Chair, CEO, and founder Marc Benioff.
Great
Good to have
you.
Back on Bloomberg. Guys, I'll send it back to you in New York.
Salesforce CEO Marc Benioff out there in San Francisco with Bloomberg Originals host Emily Chang there at the Dreamforce conference, of course, talking about security surrounding AI and, of course, those new AI products that he has been pitching. We are moving closer to those closing bells. Full market coverage coming up right now here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick here with Alex Seal, taking you to the closing bells, a global simulcast. It continues right now. Vonnie Quinn here in the TV studio, Carol Masser in the radio booth, Matt Miller by her side, filling in today for Tim Senovic. All of our audience in tune right now, Carol, to what is a massive rally across the board in U.S. equity markets.
Yeah, broad-based buying in a big way. I'm just looking at something like the semiconductor space. You look at the stocks, it's up about 4.2%. All 30 names in that index, Matt, are higher today.
Yeah, it looks like one of the biggest reactions that we've seen on the day after a Fed meeting since 2008. And it's interesting that yesterday, I'm sure you've been talking about this for the whole program, Romaine, but yesterday we had the market retreat. And I guess something happened overnight where they said, no, actually, I think this is worth a 2% pop.
Yeah, it's called the knee-jerk reaction, and then I guess, I don't know, is it a more sensible reaction, Vonnie?
I don't know, but it's fascinating because you had almost all of the sectors absolutely higher. So if you look into the map of the S&P 500, there's really very few that are lower, maybe utilities, a couple of the more defensive plays, but even the home builders as a group were lower today.
I'm gonna say it's about options tomorrow, guys. So you have the 50 basis point cuts. You have the biggest September expiration for options. We're looking at over $4 trillion worth of options expiring. You're gonna have to change your positions for that.
Yeah, and it's interesting, too, on a day like this to see the moves in the Treasury space, which is actually not a whole lot of moves at all. We're going to get back to that in just a second. But green across the screen for U.S. equity markets, more than 80% of the stocks in the benchmark indices posting gains for the day. The Dow Jones Industrial Average going to close above 42,000, up more than 500 points on the day, or roughly about 1.3% as we wait for these numbers to settle. The S&P 500, 5713.67. That's a record high, up 95 points from where it closed yesterday, a 1.7% gain. We should also point out that the NASDAQ Composite, while still far from its fresh record high, did add about 440 points today, or about 2.5%. The Russell 2000 getting in on the action as well. A gain of 2% on the day. And Carol, I just want to mention S&P 400 mid-caps up 1.7% here on the day. That is also a record high here. So interesting to see what's hitting a record high today. It's not tech, it's not the Russell, it's some of those mid-cap stocks.
Yeah, right, broadening out. We've talked about this with a lot of strategists, and this is what they want to see maybe a little bit of a healthy market, if you will, in terms of gains. Having said that, back to the big caps I go. Romaine, you mentioned this, 351 names in the S&P 500 gaining ground on this Thursday, and 148, Vonnie, to the downside.
Exactly, nearly 2/3 to the upside, as you mentioned, Carol. Let's take a look into the map of the S&P 500. Look at that, green practically across the board. As I said earlier, just a couple of defensive sectors a little lower, but really, consumer staples as a group down 0.6%. Not much to write home about when you see the outsized moves to the upside for the likes of information technology and consumer discretionary. Interestingly enough, even as we talk about the consumer weakening potentially just a little bit, we are seeing discretionary perform extraordinarily well off the back of that 50 basis point cut.
All right, so with the S&P 500 closing at its first record since July, the number one gainer in the S&P 500, everybody, Darden Restaurants, right?
Yeah.
Up more than 8%. I know, who doesn't love, like I said to
America
Matt,
is back.
There's no way that you go to Olive Garden, Carol. I highly point this out.
My dad used to love Olive Garden, and so I would go and get that tour of Italy with him.
Oh,
yeah, it was really kind of sweet.
It sounds lovely.
It was really fun. All right, Darden Restaurants up more than 8% here. Company announcing a new delivery partnership with Uber Technology, saying sales have continued to improve following soft customer traffic in July. People were a little bit worried about that. Also signaling it's succeeding at attracting cash-strapped consumers into its eateries. So big outperformer there. I mentioned the stocks, really outperformance there. All names in the stocks higher today. Advanced Micro, though, among the outperformers, up 5.6% in today's session. We really did see that Fed move give a juice to the semi-sector, also some of the AI names in particular. And then NVIDIA, I want to point out, that's another one that gained in today's session. And you saw that one up about almost 4% in today's trade. And then I just want to mention something a little bit different. Edgewise Therapeutics, it's about a $2.5 billion market cap biotech company. And this one up 54% in today's session. The company provided top-line data of its investigative therapy for heart disease in 2 trials. Investors liked what they heard. And so this one really soaring in today's trade, Matt.
All right, I have,
What do you have?
some movers that involve diseases as well, so I can top that. On the downside, right, 4D Molecular Therapeutics, FDMT.
Hey, Matt, I'm going to interrupt you here. We're actually getting FedEx earnings out right now. The shares plunging in after hours trading.
Ooh, wow.
The company providing a revenue for the first quarter, its fiscal first quarter, of $21.6 billion. That's slightly lower than what the street was looking for of $21.9. Adjusted operating margin, a big miss there, 5.6%. The street was looking for 7.4. Operating income, $1.21 billion, a big miss there. The street on average looking for 1.63. And on the EPS side, $3.60 a share. The street was looking for 4.77. And here's your forecast, and it's not good. The company's saying that full year adjusted EPS will be in a range of $20 to $21 a share. Its previous forecast was 20 to 22.
That is awful. You know, when I talk about the economy in relation to the Fed, right, I'm like, these rates aren't restrictive because we're looking at 3% growth and earnings were up 11% and unemployment's only 4.2%. If someone said, well, FedEx, the global bellwether, is going to miss on earnings and also on the outlook, I would say, okay, cut rates. That makes sense to me.
And remember that they had a fantastic quarter the last go around. I mean, they had a bullish forecast. The stock surged. I am curious. I don't see anything specifically about the consumer yet in their report. Also, remember, there's some questions about its freight unit and if they're going to spin it off, what kind of valuation that would present to unlock value, which after these numbers, you would think would be a very, very high priority.
Right. And we've been coming out of a freight recession. And so the hope was that we would see more of that this quarter round. Volumes were improving, but I guess FedEx's cost-cutting efficiency measures, all of those strategies haven't come to fruition, at least this quarter, Carol.
All right, so FedEx is down about 12% in the aftermarket. Looking at UPS, it's down more than 3% in the aftermarket. Some commentary from the FedEx President and Chief Executive, Raj Subramaniam. He says, despite a challenging quarter, we remain focused on transforming our network, improving our efficiency, lowering our cost to serve, and enhancing our ability to adapt with speed to evolving market dynamics. But obviously, those evolving market dynamics are turning out to be a little bit difficult for FedEx. Again, that stock down almost 12% here, guys, in the aftermarket.
And it's kind of interesting, too. Of course, this is the first quarter where we sort of had the reorganization of those units, and this is the first time they've reported under that. And it does make you wonder how much some of this is idiosyncratic, specifically to FedEx, with regards to its costs, which are still high, its CapEx spending, which is still high. And if there is a macroeconomic situation where we are going to see weakness in shipments or weakness in the price that FedEx can charge for those shipments, that's not going to be good.
Yeah, no, I mean, this is what I think big macroeconomists look at to sort of judge, to gauge the health of the global economy. Now, just because you miss estimates doesn't necessarily mean it's that bad, but you have to be beating what you had in the same quarter last year to show some kind of growth, and it should be consistent with at least the 3% growth that we're seeing that the Atlanta Fed now forecast sees us running at in the current economy.
Yeah, well, therein lies the rub, right? They say a low single-digit percentage revenue growth rate year over year versus their last forecast of low to mid single digits, right? So like that feels like that is a pure demand economy point. As Carol pointed out, demand trends weaker than expected. I'm interested in the call, though, guys. Are they going to talk about what they expect after the 50 basis point rate cut from the Fed? Does that change their outlook? How that's going to impact their business?
Yeah, that line on demand trends being weaker than expected, I want to hear more about that and what that actually means, because we're talking about the holiday quarter here at this point. This is when retailers are getting all their stuff. This is when the freight trains literally are running. So we'll have to see. It might mean that the Fed was right to go 50 basis points.
And this gets back, though, to that pricing issue. I mean, they say in here that they were negatively affected by that mix shift, as they put it. And we talked about this. The last quarter was a similar thing here, that volumes weren't necessarily suffering, but the type of stuff that people were shipping was not the higher margin or a higher fee stuff that they would normally ship.
Yeah, meantime, the company completed a $1 billion accelerated share buyback during the quarter, and it also expects to buy back another additional $1.5 billion stock during fiscal 2025. So continuing to keep kind of that momentum in place. But, I always wonder, buyback, I get it. But is it always the best use of your money?
Yeah, no, I mean, that's probably trying to dampen the blow, right?
Yeah,
They're like,
exactly.
we have had a horrible quarter and the outlook is really disappointing. Let's definitely buy back some shares because otherwise our price is going to get decimated in the markets, and it literally has, as we watch right now.
Yeah, right now you've seen the stock down, about 11-12% here in the aftermarket. And again, UPS a little bit lower too, down about 1.8%. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. We will see you guys again, same time, same place tomorrow.
All right, let's get right back to it here on Bloomberg Television. Our coverage continues. We're going to have a further breakdown of those results out of FedEx, a plunge in the shares in after hours trading, a conversation with the key investor, and a conversation with someone with a big read on the supply chain space. That's coming up next here on The Close on Bloomberg.
Welcome back to The Close. I'm Vonnie Quinn.
And I'm Romaine Bostick. Quite a day on Wall Street. The Fed reaction, a delayed Fed reaction, if you will, and it was a reaction that a lot of folks wanted to see. The Dow Jones Industrial Average, a record high. The S&P 500, a record high. S&P 400 mid-caps, a record high, and that is a big part of the story, Vonnie. A rotation, an embrace of not just big cap stocks, of big tech, but of course some of those economically sensitive sectors that have been lagging for months.
Number 39 in terms of records this year. Of course, there is only ever one record, right? But you have to wonder, are we going to see more of these? Want to talk about FedEx in a moment because that could have an actual impact on the market entirely tomorrow. But first, a couple of these major movers. Darden Restaurants, we've been following all day. It was the best performer in the S&P 500 today, up more than 8.25%. Bear in mind, that only brings its year-to-date gain to less than 5%, Romaine. Anemic sales, obviously, at Olive Garden, Ruth's Chris, and so on. It is adamant it is not offering discounts. I'm not sure if you've noticed, but there have been a huge spate of price wars around the burger joints, and I guess Darden won't play that game. We also had Airbnb with another great day. It's been on a string of runs now, really, since that Bernstein note. 128.75 up 5.2%, still down nearly 5% this year, but volume extremely strong in that name the past few sessions. Keep an eye on it into tomorrow and next week. And then, of course, we have to talk about FedEx, because to look at that, you wouldn't know what kind of a day it had post 4 p.m. It obviously ended the session higher, down now 9.7% after getting earnings. Investors, at least in the aftermarket, not pleased with what they're seeing in terms of EPS, in terms of cost cutting, in terms of what it means for FedEx's next quarter, and in terms of weak demand.
Most recent quarter just ended here. Adjusted earnings per share of $3.60 a share. That's a key number because the street was looking for $4.77, and a cut to the top end of its full year profit outlook. Really rattling investors right now. Let's get some insights out of one of those investors. Andrew Graham joining us right now. He's managing partner over at Jackson Square Capital. And this caught a lot of people by surprise. We know FedEx has been dealing with a lot of issues, but I think there was this hope that they were kind of starting to turn things around. And when you look at these numbers, and I know you've only had maybe a few minutes to digest them, is this about FedEx specifically, or is this more about the broader economic ecosystem?
I think it's both, Romaine. I honestly think it's both. FedEx has got a ton of overhead and excess capacity, as does UPS, and the shippers are trying to take advantage of that as much as possible. So pushing back on price. I mean, consumers think that shipping and parcel delivery is free, after all. And obviously it's not. And so they're still burning through that excess capacity and sort of an uncertain macro backdrop. Both companies are. I think there was a little bit of hope for this quarter because UPS put through some relatively egregious surcharges. I mean, the list of surcharges goes on, and FedEx basically matched all those as well. But still, they managed to come in below buy-side expectations, which were roughly $4.50. And as you mentioned, consensus at $4.77. So weaker Q2 guide, weaker full year guide. That's all bad news. Stock pulling back. And I think that's giving people an opportunity to buy it for the idiosyncratic reasons, which is why they bought it 3 months ago.
Well, I mean, talk a little bit about those idiosyncratic reasons. I mean, Raj Subramanian, he's been on the job now, I think, 2 years? He just had his 2-year anniversary back in June or July of this year. That's not a long time, but it's not a short time. He's had time to try to sort of make his mark and articulate to investors what his long-term vision is for FedEx. Are you buying into that long-term vision? Do you think it still stands?
Yeah. Yes, I do. And the stock's basically pulling back to where the second idiosyncratic driver started. Let's start with the first one, which is the cost out initiative that that Raj put through. And again, this is the first CEO of FedEx that the company has ever had other than its founder, Fred Smith. So he comes in and he's been pretty aggressive with the cost out initiative called Drive. And so that, I believe, is going to add torque to an already strong operating leverage model once volumes return to normal. And I think what you're going to see is FedEx margins improving faster than a lot of the other transport names. And then the second idiosyncratic driver is a potential to value this company on a sum of the parts valuation basis. So Raj said back, 3 months ago that they were going to do a strategic review of the freight business.
Yeah.
And that means a spin, in my opinion. There's reasons why it wouldn't be an outright sale. So they're going to spin this out, and when they do, you're going to unlock a ton of shareholder value. So that's why people were in the stock. That's why they bought it. That's why the stock had the run up. It's coming back on earnings, basically in the middle of where that gap was.
Right.
And I think people are still going to want to own the stock for that event, which we're going to hear what their plans are at the end of this year, at the end of the calendar year.
We're in conversation right now with Andrew Graham over at Jackson Square Capital. Hold that thought, Andrew. We do have some breaking news on Nike, a new CEO being named over at the company that, of course, has been without a permanent CEO for a few months. Elliott Hill will become president and chief executive officer of Nike effective October 14th. That is the press release. It is a short one. We don't have a lot of details on that, but you see the share price reaction up about 7% here in after hours trading. Of course, there was a lot of concerns going forward earlier this year, of course, with the departure of their CEO. Donahoe, of course, had come in to kind of fill that role for a while. We knew that would be temporary. And now Elliott Hill, who had been with the company previously, returning to be CEO. Bonnie.
Exactly, and most recently had been the president of the consumer and marketplace segment of Nike, and really had been with the company at least since 2004 up to the year of 2020. So we'll see how that impacts the stock price tomorrow. Certainly today, we did see Nike, along with some of the other segments, really not do too much. But Nike has had a troubled few months and few quarters, Romain. It hasn't had the kind of outperformance that it would like to have had.
Yeah, and we should point out too, there was a great story that our team here at Bloomberg wrote last week here about sort of the big change that they made at the top, of course, with Donahoe and this idea of this quote unquote Bain playbook, this idea that you had a previous chief executive there who was just very much steeped in that sort of Nike culture, sportswear culture, marketing culture. And they brought in John, who was more of a numbers guy. He was a smart guy. He knew how to run a business here. But he basically became this sort of, metrics and all this stuff. And what ended up happening was, you just had this influx of certain shoes, like, the Panda Dunks, which are everywhere. Unfortunately, as you know, in fashion, if everybody's wearing the same thing, eventually nobody wants to wear them. And that was a problem they ran into here. But it may be a little bit clarity going forward. I want to give our thanks, though, to Andrew Graham. Apologies for cutting him off, managing partner over at Jackson Square Capital. We will continue to keep an eye on FedEx as those shares continue to plunge here in after hours trading. We'll also get you some more info on Nike as well. When we come back, though, that conversation on FedEx continuing with a deeper dive into the broader freight industry. And who better to talk to than Craig Fuller over at Freightwave. This is Bloomberg. All right, keeping an eye on two of the biggest movers in after hours trading, Nike to the upside and FedEx to the downside, a 9% plunge in that stock on the back of a disappointing earnings report and raising a lot of questions about the health right now of the shipping market. Who better to talk to than Craig Fuller? He is the founder and CEO of Freightwave. And Craig, look, I know FedEx might be its own individual story, but even before we got to FedEx earnings, there was a lot of talk about capacity in the shipping space, in the U.S. shipping space, particularly when it comes to trucking. And the idea that maybe we just still had too much capacity on the road for the number of packages that were going to be shipped. What are you seeing?
That's absolutely the case. We've coined this the Great Freight Recession. We're now into our third year. in one of the longest downturns in freight history. So if you sort of look at what's been taking place, the domestic freight market collapsed in March of 2022 and has not recovered since then. And we're looking at potentially the second half of the year also being challenging and not showing really any significant signs of recovery so far.
Has there not been consolidation, though, Craig? I mean, I know there's been a few deals here and there in the trucking space and even on the sort of broker space with the RXO earlier this week announcing a deal. But I assume that's not been enough to really solve the problem.
Well, brokers don't really consolidate because ultimately this is a capacity situation. It's actually having assets. Brokers don't control those assets.
Gotcha.
So when you see brokerage transactions, think of it like a trading, one group of traders buying another group of traders. Brokers are effectively the day traders of the market. They don't really impact the capacity map of the market. But what does impact the capacity map of the market is really bankruptcies and consolidation. And largely this is a bankruptcy story. Yellow left the LTL business. It had about 9% of the LTL market when it left the market. And that created really nice tailwinds for a lot of the LTL players. And what we're probably looking at in terms of FedEx's challenges is those year-over-year comps in their freight business are going to be more challenging because they got the short-term benefit of Yellow's failures that took place a year ago. So they picked up a lot of volume. They got to reprice a lot of that freight because shippers were scrambling for capacity. And now that one-time gain just isn't there. And so I think what we're seeing with FedEx is really the economy, the freight economy, is not creating a ton of demand or forward demand at a time when the comps are just more challenging.
Yeah, exactly. FedEx literally saying demand trends are weaker than expected. But if freight is a commodity, Craig, why are these supply and demand factors not coming into sort of balance at this point? You would expect that they would, right?
Well, I'm glad you said freight a commodity because it's absolutely a commodity. But there's two sides of that supply and demand balance. There is the demand side of it, which is one story. And frankly, demand has been weaker than what most of the market would like to see, but not demonstrably bad. And you can look at the economic data to see that the economy is okay and doing okay and has been doing okay. The story that really matters is the capacity. It's the supply side of the equation. And frankly, what we saw during COVID was just a rapid expansion of capacity. We added 28% more trucks from pre-COVID levels to really the peak of the market, 2022. And the industry is still trying to get rid of all that excess capacity. And what's happened is that capacity has hung around a lot longer than what most companies expected and what most executives expected, and has really kept both pricing weak and volumes weak relative to the whole market. So what we're seeing is just too much capacity and too much supply in the market that is keeping pricing low and is also distributing volume around a lot more participants than what everyone would like.
Always fantastic to hear from you, Craig. Thank you so much for joining us. That is Craig Fuller, founder and CEO of Freightwave.
Of course, FedEx right now, the biggest decliner, at least among major stocks in after-hours trading. The biggest gainer, well, that belongs to Nike, up about 9% on the news that Elliott Hill has been named as new CEO of the company. He starts in a few weeks. Joining us right now is Lily Meyer of Bloomberg News, who wrote a great story that was published last week about the outgoing CEO, John Donahue, former Bain guy who maybe made a few mistakes. What's going on here?
Yeah, thanks so much for having me. So yeah, when we wrote the story, John was still CEO, and I think many Nike employees are going to be really excited that Elliott is coming back to the company.
And we should point out, Elliott, as well as a couple other executives, left when Donahue came on, right?
Exactly.
Yeah.
For sure. Now, he's been with the company, or had been up until 2020. He'd been with the company since 2004. Is he popular? Did he really get to make some great decisions there?
Yeah, I mean, I have to tell you, out of all of the employees and former employees that we spoke to, his name kept coming up. He's super beloved in the Nike community, and so people will be really excited to hear the news.
Well, give me I'm not too familiar with his background, but give me his background, because I thought it was interesting when Mark Parker left, there was this idea that he was like a sports guy, a Nike guy. He understood marketing, he understood fashion, all those things that made Nike special. Donahue wasn't cut from that same cloth. I assume Elliott Hill is more akin to a Mark Parker? Is that a fair way to describe him?
Yeah, I mean, I'm not sure how he compares to Marc, but I think the big thing about Elliott is he's like homebred. He's from Nike. He had a long career at Nike, and John was totally new. He was an outsider. He had been on the board, but he hadn't worked for the company before.
Yeah, and this gets to the idea as to what they need to do to change, right? Donahoe made, and for you should point out, Donahoe did a lot of good things when it comes to the tech side of the business, the direct-to-consumer. I know there were some concerns about the partnerships with third parties. How is that going to have to be sorted out?
Yeah, I'm really curious to see what Elliott is thinking and what he's planning to do. I mean, he has a big job ahead of him.
All right. Well, thanks for jumping on so quickly for us. Lily Meyer, she wrote a great story. I encourage everyone to read it just last week here, talking about some of the issues ailing Nike and its CEO. And now the breaking news today that CEO is out. A new CEO is in. Elliott Hill, a former executive returning to the company. He officially starts, according to the press release, on October 14th. All right, when we come back, we're going to stick with earnings. We are expecting to get some out of the home builder Lennar any minute now, and we will bring them to you as soon as we get them. A broader read on the health of the economy. Stick with us as we keep an eye on some of the other big movers on the day. Nike still moving higher here on the day. FedEx still down. This is The Close on Bloomberg. Welcome back to The Close. A wild day on Wall Street and getting even wilder here in the after-hour trade. Earnings season is still in effect. We heard from FedEx. We got a management change over at Nike and now Lennar, the home builder. Those earnings crossing the wire. The company in the most recent quarter, it looks like it beat on EPS, $4.26 a share. That's up from $3.87 the previous year. Not quite sure what that compares to on the analyst estimates here, but you see the share price reaction. Revenue also coming in at about $9.4 billion. The street was looking for $9.2. And here's your forecast. The company says that it expects new orders for the fourth quarter in the 19,000 to 19,300 range. The street had been looking for 19,100. And the company says that it sees 4Q deliveries also, Vonnie, coming in a little bit higher than what the street was looking for. 22,500 to 23,000. The street was looking for 22,008.
And it adds credence to the idea that perhaps we are seeing a little bit of a turnaround for home builders generally, even as we hear from the Federal Reserve Chair that, housing is part of the stickiest parts of inflation. But we were expecting closing volumes here to rise 13%. Argus was saying the average selling price would be down 14%. So definitely dynamics in the housing market changing. Joining us now for more of a read into this literally is Drew Redding, U.S. home building analyst at Bloomberg Intelligence. So Drew, did Lennar outperform as we anticipated? Is it telling us anything more about the housing market?
Yeah, so it looks like Lennar from a volume perspective was pretty much in line with their guidance, which was expected because you have to remember Lennar's operating philosophy calls for them to drive volume sales, and they're willing to give up some gross margin and able to do that. And it looks like with rates elevated through about a third of their fiscal quarter, it looks like maybe they had to ramp up their use of incentives a little bit. It looks like gross margin might have been a little bit light. But once again, their strategy is about driving volume and generating cash. It looks like they did that this quarter, and their forward guidance says that as well.
So, Drew, remind us here, what's sort of the target customer for Lennar? What types of homes are they building?
Yeah, so Lennar builds pretty much across the price spectrum from, the low-end entry level to the move-up and luxury market. Right now, they're one of the most consciously focused on price because they recognize the affordability constraints that are plaguing the market. So, they have a technology platform that enables them to adjust their pricing on the fly to meet the market on price, and that's what they're doing.
And some more research suggests that Lennar does actually have the heft to buy new lots as it comes online. What happens if Kamala Harris gets elected? We know that she has some policies for the housing market. How would that impact Lennar?
Yeah, so a lot of the policies that have been proposed are really beneficial, I guess, to the entry-level home buyer. It's talking about offering tax credits to entry-level builders, tax incentives on the demand side. That being said, we think it's going to be difficult to implement a lot of those supply-side measures because they take time and there's a lot of challenges in their way. At the same time, when you talk about demand-side stimulants, such as a $25,000 first-time homebuyer down payment assistance program, we think that has the potential to be inflationary for housing.
That's interesting. And I do sort of wonder then, I know these companies, at least the home builders, they're operating on a much different timetable than what most of us are looking at. They're looking, 5, 10 years, even more down the road here. Are there structural shifts right now in the U.S. here with regards to where homes get built, the types of homes that get built, and whether Lennar is in that sweet spot to take advantage of it?
Yeah, so the public builders as a whole really concentrate their business around the South, the coastal markets through the West. So the Smile States, really, that's where all the population growth has been. That's where the job growth is, and that's where all the builders are. And really, those have been some of the strongest markets in the country. In terms of what product they're building, there has been a shift over the last several years to lower square footage homes. We did see square footage ramp up during the pandemic as people were looking for space, but we started to see that trend reverse now. And the reason is because builders have found that they could address affordability through their product, offering lower square footage, less amenitized homes. Another way they're doing that is through, higher density and maybe even through townhome construction.
All right, Drew, thanks for jumping on here. Drew Redding over at Bloomberg Intelligence, our home building analyst. A closer look at those results that we just got out of Lennar. Those shares up about 1% here in after-hour trading. Of course, the interest rate story is a big part of the home building story. It's also a big focus for municipal bonds. It's time now for our Muni moment. And joining us right now is Stephanie Larosiliere, Head of Fixed Income Business Strategy and Development over at Invesco. Great to see you here, Stephanie. After the Fed, because prior to the Fed meeting, there was a lot of talk, at least here at Bloomberg, about the number of bond buyers we were seeing that were really trying to snatch up these muni deals, trying to lock in those higher rates. We got a 50 basis point cut yesterday here with the expectation we're going to get a lot more over the next few months. Is that going to help or hinder what's going on in the muni space?
Yeah, we expect it to help. The market telegraphed an expectation of 25 basis points. We got 50. I think the Fed was really careful in how they did this and the commentary around it. It's clear that, if they were, the tone was different, they would have spooked the market. I think they did a great job of not doing that. And now we still have that $6 trillion in money markets that is looking for a place to get invested. And we are feeling bullish about the longer end of the curve. We are feeling bullish about high yield munis. We've got two funds in that space that do tremendously well, and high yield munis tend to be tied to the economy. So as long as we continue to believe that there is economic strength, we feel good about those strategies.
I'm glad you went there, because one of the big takeaways from yesterday's Fed meeting wasn't really just the rate cut, but the idea here of the direction of the economy. And I think we saw that today, certainly in equity markets, that people seem to feel like the economy is in a good place. The Fed is there to support it. And thus you saw a big rotation into small cap stocks, mid cap stocks. When it comes to munis, you mentioned high yield there. This gives people a little bit more cover to extend duration and, more importantly, go slightly down in credit quality?
Yeah, we think so. We think, when we look at high yield munis, they tend to be as tied to the economy as you can get. You're talking about your water, sewer, you're talking about your toll roads, you're talking about your hospitals, universities, all the things that we know and use on a daily basis. So there really isn't, I don't think you get closer to being tied to the everyday economy than you do in munis. And when we think of high yield, we're thinking of those projects that might be a little bit more speculative grade, but are projects that are necessary, are projects that sometimes come to the market without a rating because they know they're going to have a pretty good following, but the underlying credit fundamentals we think are strong. And being a big player in that market, we're able to dictate terms on those deals and get really great yields that we can pass on to shareholders. We've got, two funds paying in excess of 5% tax-free right now. I think that's a pretty great deal.
What are the community of investors saying about whether the muni bond tax break will or might be scrapped after the election, Stephanie?
We see this every single election, and I got to be honest, I have yet to take it seriously. I think at the end of the day, when it comes to the tax exemption of munis, that is something that the retail investor has become part of the way that they manage their finances, right? It becomes part of planning, financial planning, and I don't think that goes away. What could be interesting, and I've heard, some rumblings of this, is SALT cap deduction potentially going away. That would be a good thing for munis, but we don't think the tax exemption goes away. It comes up every 4 years, like clockwork, and it never actually happens.
The return for the junk part of the Muniverse has been about 5%, and for sort of the regular grade, it's been less than 0.5%. In fact, Stephanie, why is there so much money going into the muni bond universe, given that you could have got 5% anyway, just sitting in cash?
Well, a 5% tax-free is a little bit different. And I think munis add a level of diversity that is very difficult to get in other parts of the market. You talked about, below investment grade seeing the bulk of that cash. Well, below investment grade munis, and we talk about high yield in the non-rated market, that tends to add a level of, lack of correlation to the rest of the market that you would be hard pressed to find in the taxable market, really. We have more and more where we're seeing, corporate bonds and equities being more highly correlated. But in the muni market, you do get that benefit of that diversification. I think a lot of investors are looking for that.
All right, great stuff as always. Stephanie Larosiliere, head of fixed income business strategy and development over at Invesco for our Muni moment. And you did see some of those bond indexes, including the Muni indexes, rally today here, Vonnie, on a day where a lot of people are really starting to price back in that proverbial soft landing. You see it on the screen there. The NASDAQ had a phenomenal day, up about 2.5%, but it was really about what everyone else did. S&P 400 mid-caps hitting a record high. Dow Industrials also at a record high.
It was very little that didn't rally. I think the VIX didn't rally. I can say that. It was down, but still above 16. But we had Bitcoin rallying. We had so many of the commodities rallying too, Romain.
Yeah, a bid back into those commodities could actually be key, and risk appetite back on top, at least for today, for the crypto space. Stick with us. This is The Close on Bloomberg.
I think it can bring greater access and promote markets, but at the same time, we have to guard against fraud, and fraud is fraud. And whether you're using an algorithm to defraud the market or your human is doing it, it's against the rules. I do think that there's a challenge that the financial crisis of the future might be that we say, oh my gosh, we were all relying on the same model, the same algorithm, the same data. That's a challenge that is on this guy's mind.
That was Securities and Exchange Commission Chair Gary Gensler weighing in on the pros and cons of artificial intelligence. His concerns over the risks related to AI are shared by experts at the United Nations. The UN advisory body on AI is out with its extensive Governing AI for Humanity report. That report outlines how to best address AI-related risks with a list of recommendations, such as setting up an international panel and a global fund. Joining us now for more is Alondra Nelson. She's a member of the UN's advisory body on AI and the director of the Office of Science and Technology Policy. Alondra, thanks for joining. I'm curious as to which countries might listen to the United Nations on this, given that so many countries and groups of countries and intergovernmental bodies and so on are trying to be the global regulator on AI.
Well, thank you for having me. The report just came out today, and I think what preceded the report is really important in response to your question, which was a U.S.-led resolution to the United Nations General Assembly that said that AI governance should abide human rights law and the UN Charter, and was signed on to by all 193 member states and had more than 120 countries co-sponsoring it. So there's a lot we disagree about with regards to AI, but there's quite a lot. There's a kind of fundamental anchoring principles that there's some agreement about, even in an organization like the UN, where it's hard to get countries to agree about much of anything.
Yeah, that might be an understatement. And I guess that leads me to my next question, Alondra, which is really how do you do this, particularly given that AI, or the race in this AI space, it's at full speed right now. And you guys, not just you at the UN, but all these individual nations here in the US, we're still debating what type of policy is necessary. How do you catch up?
Well, we do have to catch up, and I think it's, the challenge of the multilateral setting like the UN is that we need a new kind of multilateralism. So if we think about prior times when we were trying to solve global problems, we turned to states. And an issue like AI has industry and company stakeholders sitting right in the middle of this. And so I think part of what the report offers is two things that are important: a kind of sense of urgency. This committee spun up very quickly. We finished our work in less than a year's time, which in bureaucracy terms is like, lightning speed. And moreover, it's a process that was deliberately multi-sector. So business at the table, civil society at the table, and government at the table. So I think there's an understanding that we need new tools and new ways and networks of thinking about how to do this. That said, in the middle of all of this, various various countries are trying to figure out how to do it. Here in the United States, we still don't have strong regulation around data privacy. We're still trying to figure out, as Chair Gensler was just saying, what are the laws that we need? We know that things that are illegal in other contexts, real estate discrimination, finance, scams in the finance space, disinformation, misinformation, all of those things are problems, but they're put on steroids in the AI space, and we're trying to still figure out how to do that. I think I would just add, Romaine, one of the things we can do is use the laws that we have, and I think Chair Gensler has been doing that. What can you do already? And then also think about new ways of pivoting to offer new laws around. We've got things around copyright and the like.
But those laws also, and I mean that's important. But those are going to apply to a certain extent to individuals, corporations, the private sector, if you will. As you know, there's a huge national security component to this. You've had the ear of the president, and is there any sense here that when we talk about trying to get all these nations to coordinate, nations that are often adversarial with each other, how do you even create an environment of trust to say, okay, we're not going to do this, and then we're just going to go away and trust that X nation isn't going to do that?
Right. I mean, it's a challenge, particularly in the national policy space. I mean, AI is the biggest geopolitical sort of tool and opportunity and also challenge that we're going to face in our lifetimes. And so I think as always, in geopolitics, you're trying to find this kind of fine line of cooperation and competition. Clearly, the competition between the U.S. and China here is pronounced. But, I mentioned to you that earlier UN General Assembly resolution led by the United States, China signed on to that. And so I think we want to, have, high walls, high garden walls when you need them and open windows as you can to find that sort of fine line.
But to Romaine's point, Alondra, how do we even know what, for example, China has? I mean, obviously the US wants this and every country will say they want this, but are they going to open up their books?
Well, we can't even get the companies to open up their books, obviously. So a closed, nation is not going to open their books. So it remains a big challenge. I mean, part of what the UN report is trying to do is offer, I think, very modest on-ramps to do some of that. So there's a proposal for something like the IPCC that we have for climate change around AI, where we begin to at least create a kind of ground truth. So, I think we do this in other industries. We do it in pharma. We do it in finance, where people are able to share information that's not revealing their IP. So how do we get to a space where we have a shared ground truth around what the AI tools are and what they do? That's not, revelatory of, state secrets or IP.
Is this
but obviously, yeah, sure.
An area where companies perhaps are more powerful than governments in some ways, because if let's say OpenAI or Microsoft or whoever else doesn't like what the US is proposing, it can just go and operate somewhere else with somebody else's backing.
That's such a great point. I mean, that was a little bit the point I was making at the top around the new multilateralism. I mean, part of what's multilateral here are multinational corporations that operate in all of these spaces simultaneously. I do think it's true. We've seen with something called the Brussels effect that, companies are making choices about how they want to respond to different regulatory contexts. And sometimes it's, easier just to respond to the hard one in all of your products. And that sort of trickles down to markets across the world. So we'll see what happens with AI and how strong the Brussels effect will be, given the European Union's AI Act that was finally passed after a lot of process earlier this year. And, the United States doesn't yet have, a lot of robust policy or law around AI. And so, companies that are multilateral, multinational are left with, dealing with EU policy right now.
I only have time for one more question, Alondra. And this is a broader question just about AI in general. I mean, you're really just one of the brightest minds in science right now. We're talking about AI as if it's something new. I mean, as I'm sure you know, this goes back decades, really, at least to the 1950s and even prior to that here. Is there a sense that what we're talking about now and the potential transformative effect on our economy, on national security, and all these things we're talking about, is that real? Do you see that as real?
It is real. I mean, this is a powerful technology. It's already shown its power, and some of the, the concerns that Chair Gensler, for example, has around markets. We're already seeing some of its power and shaping misinformation and disinformation, which has all sorts of implications for broader society. So we can think about, kind of the election misinformation and disinformation we're experiencing right now. So, one way of answering your question, Romaine, is that part of what we know for sure that it does, beyond a lot of the speculation, is that it really amplifies both the velocity and the scale of a lot of the challenges that we already face. space, including things like misinformation and just disinformation. So, you know, if Skynet, for example, never comes to pass, we still have a lot of problems and hopefully a lot of potential opportunities with the AI that we have today.
All right, Alondra, this was a real treat, and we'd love to talk to you again when you have the time. One of the brightest minds in science there, Alondra Nelson, who is now a member of the United Nations Advisory Body on AI. All right, there's been a lot going on here in the after-hour trade, Vani, including that somewhat surprising news on Nike, a new CEO being appointed, Elliott Hill, and now we're learning that one of their previous CEOs, Mark Parker, he is actually, who is also the executive chairman, we should say, writing a note to staff today that we have now obtained, where he's basically saying that Nike will return its focus to athletes. This according to the former CEO, Mark Parker, saying that the new CEO, Elliott Hill, who will be taking over for Donahoe in October, saying that we are all aware of the challenges that Nike has faced and that there will be a return to focus on athletics.
And I think to some extent this was expected. I mean, Donahoe had been at the helm for 5 years.
Yeah.
As you said, he had done some fantastic things at Nike, right? Just recently, investors hadn't really been rewarding the company for just not being innovative enough, maybe not changing constantly enough. We all know fashion changes constantly, and you have the likes of On and Hoka making a big entry into the...
Yeah, well, that's the thing. It wasn't just fashion, right? I mean, you talk about athletics. I mean, how many people do you know who are runners, and you ask them what they wear? They're not Nikes anymore. It's Hoka, it's On, the On Cloud, and these other ones that just kind of came out of nowhere. And there are a lot of people that are saying that wasn't because those brands were so great. It was because, at least in the perception, was that Nike just wasn't as good.
Exactly. And after the bell, Nike up 10%. So investors looking forward to seeing what Elliott's going to do. Yeah, it'll be interesting to see. Of course, he hits the ground running next month. And we should point out, he was a former executive there and left when Donahoe came in. So he knows the company well. We're seeing this quite a lot recently, aren't we, with executives coming back to companies to take the helm again?
Yeah, absolutely there. Okay, a lot to talk about over the next 24 hours and some other potential market moving events as well up ahead. We're going to break that down for you when we come back after the break. This is The Close on Bloomberg. All right, to push ahead to some of the potential market-moving events over the next 24 hours, and we start out in Japan, a big decision by their central bank. Will they hike again? No economist in our survey says they will, but there are a couple of lone voices out there saying that we will get another hike. It has the potential to roil markets, but, you know, after the Fed decision, it's unlikely that we'll see that. Yeah, maybe that 50 basis point cut here gave Japan bank a little bit more breathing room. Meanwhile, back here in the U.S., get this. Early voting starts for the U.S. election, which is still 47 days away, but Minnesota, South Dakota, and Virginia start voting. Only 47 days away, though. It's crazy. And then we also have triple witching tomorrow. That's going to be a huge one and might inject some volatility back into this market, which has seen quite a lot of volatility recently. Yeah, about $5.1 trillion worth of options set to go out, set to be replaced, and that will sort of lead potentially to a big rotation. That also comes on the same day that we get the S&P and Dow indices doing that quarterly rebalance. Friday, that will be the last day you see what it looks like now. We get the likes of Palantir and Dell joining the S&P 500. All right, that does it for us here on The Close. Tune in tomorrow for all of your market coverage. In the meantime, for all of your politics coverage, stick around. Balance of Power coming up at the top of the hour right here on Bloomberg.